everyone. I'm Megan Trask, Director of the Investment Committee, and I'm joined by our Assistant Director, John Shanley. We're here today to talk about a change to our client portfolios that will pretty much be happening across the board. This change will impact the bond side of the portfolio. You've probably heard John and I say in other videos this year that while it's been really tough to watch what stocks have been doing this year, declines like this are a part of normal, even healthy, full market cycles. They're in some ways behaving as we would expect them to behave in this environment. What's been a little bit more unprecedented is really what is happening on the bond side. So, John, do you want to talk a little bit more in detail about the changes we're proposing there?
Absolutely. I feel like, Megan, we've used the word historical so many times these last 2 years, but you're spot on. What's happened in the bond market this year really is historical. But it's also exciting in the sense that it offers new opportunities. Before we get into the trade specifics itself, I think a good starting point is to lay out some definitions. When we think about investing in bonds, there's really two types of risks that we take on. There is something called duration risk and credit risk. And we sometimes like to explain it similar to how when you go and try to buy a mortgage. Duration risk is the idea of how long is that bond in place for? How many years until it matures? Similar to getting a mortgage, right? Am I going to get a 15-year mortgage or 30? The longer the bond, similar to the mortgage, the higher the interest rate you're going to get. So that's one of the risk factors that we can hone in on as investors. The other is called credit risk, which all comes down to the creditworthiness of the borrower. So if you have a wonderful credit score and I didn't, you should get a better rate on your debt. Those exact same principles apply to investing in the bond market. Whether you're loaning money to an institution or a corporation, whoever it might be, the risk that you're going to receive and the return that you're going to receive will be based upon how you manage duration and credit. So that brings us to today and really what we've been positioned for over the last handful of years. We decided in our portfolio to be shorter on the duration side because a couple of years back, interest rates were incredibly low and there didn't seem to be that much opportunity to take risks in the duration space. We thought interest rates would eventually increase. And here we are, and they've increased quite substantially. And to help balance out that kind of shorter duration position, we did add some credit exposure to find opportunities to get a little bit more yield in our portfolio. We sit here today and that decision worked out really well from a relative standpoint. If we had done nothing and stayed where we were before that, the returns would have been worse than what we've seen. So that idea of being shorter duration and taking a little bit of credit risk was additive to the entire portfolio. But obviously we then think about what is the opportunity set today? And what's been remarkable is that interest rates have increased. You can now find really safer corporate debt, treasury debt, that is yielding relatively attractive rates of return.
I think actually it makes sense to bring it back to the mortgage market again because people are more familiar with that.
Absolutely.
In February, you could get a 30-year mortgage for 2.9%, maybe 3%. Today, we're looking at 30-year mortgage rates at 6%. That is a massive increase in a really short period of time. And so a very similar type movement happened in the bond market.
Exactly right. And I think we've talked about this before. The ride to get here has been swift and painful. It's like we ripped a Band-Aid off. But again, when we think about the future returns for our bonds, it's actually exciting, right? We have opportunities out there. And so we are now able to reduce some of our credit risk, right? It's going to be a lever we pull down a little bit. We don't need to take that risk because some of those core parts of our portfolio are now yielding what we need them to yield for clients to reach their financial objectives. So from a very high level, we are reducing our our strategic income position, one of the more credit-focused positions, and we're removing one of our lower duration bond funds, and we're adding it back into that kind of core part of our portfolio. And, again, I kind of said it before, but it's a really exciting time in the bond landscape because more opportunities arise. Whenever there's uncertainty in the markets, we're always looking out. These are the times to find the opportunities and to really hone in on both the risk and return you're taking in the portfolio. And I think aligned with that is something I feel like we haven't really had much to say about over the last handful of years, which is cash-like investments and short-term bonds. So maybe you can expand a little bit on that, Megan.
Yeah, so I think the theme of what John just described is that conservative investments are finally yielding a little bit more for investors. Finally, the expected return has gone up a little bit. And so this applies to cash alternative investments as well. So for clients who have extra cash, whether it's because you wanted it for some peace of mind, or you have a purchase that you're earmarking some cash for, with a couple of years time horizon. Prior to the last couple of months, we said, keep it in your savings account. You're not being compensated by taking on any amount of risk in these ultra short bond funds. Well, that environment really has changed. You can take on a pretty minimal amount of risk and actually now receive some yield for your kind of cash alternative investments. They're cash alternatives. They are different than cash. It does involve a little bit of investment risk, but again, now we're finally in an environment where we think it makes sense to take that on in circumstances depending on the horizon for that cash need. I can't help but digress a little bit as we're talking about cash, because I think those two categories are different. Earmarking cash for a specific purchase with a definite time horizon, and then just having kind of excess cash for opportunities for that peace of mind. It's kind of two different things. For those who have cash on the sidelines because, you're waiting for an opportunity, again, on the opposite end of the spectrum, if you're willing to take on a little risk, it certainly seems like a good time in the stock market to put a little cash to work. Some data that supports that is, it's kind of interesting. So we're in the 13th bear market since World War II. If we look at 7 out of the 12 last bear markets, once we hit that 20% decline, the bottom followed within 46 days. So we try not to prognosticate because you just never know what the future will hold. But again, when we look back throughout history, when stocks have declined 20%, it's usually a pretty good time to, if you have the risk tolerance, if you have excess cash, to put some of that to work. So just as John described, there are risks out there. There's a lot of uncertainty, but markets like this do tend to present opportunities as well.
It's such an important data point too, and it all comes back to the idea of finding opportunities in time of distress. It has obviously been a challenging environment for stocks, for bonds, but whenever we think about the future, right, things are on sale, bonds are starting to earn more interest, stocks are 25% cheaper than they were 6 months ago. These are the times where you can really start to leverage some opportunities.
Absolutely. So if you have any questions about the changes we're talking about today and some of the opportunities that are out there, please don't hesitate to reach out. And as always, thank you so much for your trust, for your confidence during these times.